Right, so we're just going to go through the markets as usual, see what the markets has in store for us, and then we'll take questions and issues afterwards. Okay, so as usual, we start off with the economic calendar. Let me just bring that up. Okay, so, oops, that's the market watch. So economic calendar. So we're going to start off with the economic calendar. Again, the main market we're looking at is the Euro-US dollar. So we're looking for reports of high importance and also noting reports of medium importance that could affect the euro or the US dollar. So today is Tuesday, the 19th of January. Don't forget using GMT plus 2 time. So you make sure you adjust your economic calendar to your own time zone. But I'll be quoting Rwandan time GMT plus 2. Obviously, we all know that yesterday was a public holiday, Martin Luther King Day. So we all avoided trading in the market yesterday, but there are no public holidays today or the rest of the week. So we can get back to trading today. So we can see straight ahead at 9 o'clock, which is in less than an hour's time. At 9 o'clock, we have the Germany inflation rate. Again, I'll always repeat, there are 4 reports that are always of major importance. There are 4 reports that are always of major importance. Inflation rate, which is one of them. Gross domestic product, which is another one. Unemployment, and then interest rates. Obviously, when it comes to trading currencies, interest rates are really the ones of the highest importance. Interest rates, currencies are very sensitive to interest rates. So interest rate is always the biggest one, the big number one, interest rates. And then obviously gross domestic product, unemployment, and inflation. And of course, as we know, Germany is the main powerhouse in Europe. So obviously that could affect the euro in Euro-US dollar. So that's the first report of high importance today, the Germany inflation rate at 9 o'clock GMT plus 2, which is in less than an hour's time. So we certainly want to avoid trading prior to that. We can ignore reports of low importance. That's Hong Kong, that's Italy, you can ignore all that. Then at 12 noon, again, GMT plus 2, we have the ZEW Economic Sentiment Index of the Euro area. And at the same time, we have the ZEW Economic Sentiment Index for Germany, both at the same time at 12 noon. And then the rest is just low importance. Okay, so that's it. So that's the major reports today at 9 o'clock and at 12 noon. So again, like I always say, you have to take each day on its own merit. You take each day on its own merit. The teaching is, and the wisdom is that you want to avoid trading prior to the last report of high importance of the day affecting the market you're trading. You want to wait till the last report of high importance. The last report of high importance today is at 12 noon. The ZEW Economic Sentiment Index from Euro area and Germany. But for today in particular, the Germany inflation rate report is extremely more important than this report's coming out at 12 noon. So I will have a first attempt at the market around 9 o'clock, which is in less than an hour's time, because this could move the market at 9. So I won't wait till 12 noon. And luckily, it's a new year. The American elections are over. Things are sort of back to normal. What I mean back to normal is that, the normal madness in the market, in terms of, things affecting the stock market, trade deals between countries, and normal negotiations. So since things are sort of back to normal, as in there's no major uncertainty in the markets, there's nothing causing major uncertainty. We all are aware of the COVID. The COVID has been around for over a year. Well, not over a year, but it's been around for almost a year now. We all come to terms with COVID, the lockdowns, the restrictions, the travel restrictions, and obviously the vaccine has now come into play. So when it comes to COVID, there's no uncertainty in inverted commas. We know everything about COVID now. We know the effects. We know about the vaccine. We know about the race to vaccinate as many people as possible. We know about the travel restrictions, the intermittent lockdowns and all that, the variant strains. So like I said, when it comes to trading, the key word is uncertainty. That's the key word, uncertainty. Because leading up to the presidential elections, we found that obviously from October, November, December was difficult to trade. The markets were terrible, October, November, December, because we had the build up to the US presidential elections, all the madness that went on and the uncertainty with the presidential elections. And of course, Donald Trump refusing to concede after the elections and going to court and blah, blah, blah. So all that just made trading extremely difficult and not very profitable October, November, December because of the uncertainty. Uncertainty, that's the key word. But now all that has been resolved in America. Joe Biden is going to be sworn in tomorrow, 20th. We know about the COVID, so there's no more uncertainty in the markets. So in view of that, we can go back to having 3 attempts, maximum of 3 attempts in the market every day. Because if you notice during the period of uncertainty over the last couple of months, I've only been having only 1 attempt at the market on a daily basis, just 1 attempt. But now that all that uncertainty is gone, I'll be going back to having 3 attempts, maximum of 3 attempts a day. Obviously, you don't force 3 attempts. You choose your attempts wisely, but you can have up to 3 attempts, but you don't have to have 3 attempts. If there are 3 good attempts that you can take, then you take it. Okay. So the reason why I was emphasizing all that is that today, with there not been any public holidays today, and like I said, the major uncertainties are out of the way, I can have my first attempt at the market around 9. So I'll avoid trading now, wait till just before 9 o'clock, and then place my pending orders in preparation for that report. If the market takes my order and I lose out on that trade at 9, then I'll stop trading and wait till 12 noon before I have my second attempt at the market. Okay, so that's why I was emphasizing that now I'm back to having up to 3 attempts a day. Okay. So that's what I'm going to be doing today. I'm going to avoid the markets till 9. Then just before that report, reassess, place my orders. If obviously the market doesn't take my order, and then obviously you just leave it there till it takes your order or not. But if it does take it and I lose out, then I'll stop trading and wait till 12 noon before I have another attempt at the market. Okay, so let's also look at the rest of the week as usual. See what else is coming up for the rest of the week. So tomorrow, we have the UK inflation rate due out tomorrow and the Euro area inflation rate due out tomorrow. So we have more reports of high importance. Then if you're trading currencies paired with the Canadian dollar, then you can see you have the Bank of Canada interest rate decision tomorrow. Obviously, again, like I said, interest rate decisions are of extremely high importance when it comes to currency trading. So if you're trading currencies paired with the Canadian dollar, that will be of extreme importance to you tomorrow, along with the inflation rate. Then Thursday, that's the Australian unemployment rate. If you're trading currencies paired with the Aussie dollar. And then Japan, we have the Bank of Japan interest rate decision on Thursday morning at 5 o'clock in the morning, Rwandan time. So again, if you're trading currencies paired to the yen, that will be of extremely high importance, the Bank of Japan interest rate decision. And then same on Thursday, we have the one that is relevant to us, the European Central Bank interest rate decision on Thursday. So that's another report of extremely high importance coming up on Thursday. Actually, I'll set up a session so we can trade this report together on Thursday afternoon. It's good. Like I said, this interest rate decisions are of extremely high importance, and currencies are sensitive to that. And since we're trading the Euro-US dollar, that will have an impact on the Euro-US dollar on Thursday. So we'll set up a session for us to trade that report on Thursday afternoon. And then Friday, we have Japan inflation rate. And that's it. Okay, so the big one for us this week, specifically for the Euro-US dollar, is the European Central Bank interest rate decision on Thursday afternoon. Don't forget Market Watch to check to see if there's anything major or terrible going on in the financial news. But like I said earlier, there's nothing new causing uncertainty. But of course, you need to check for yourselves. Don't just take my word for it. You need to make sure you keep your eyes on the financial news and see what's going on. But like I said, yes, not much is happening. Okay, so with that in mind, let's have a look at the charts. So we'll start with the swing trading. So we'll go to the daily time frame. Okay, so this is D1, the daily time frame. So of course, from a swing trading point of view, we saw where the market broke the moving average on Friday, took my pending sell swing trade order. Usually when the market takes my order, I wait till the market has moved about 100 pips in my direction before I start moving my stop loss with the moving average, which that hasn't happened yet. It hasn't yet moved 100 pips in my direction. So you can see my 100 pips stop loss is still in place. And I'll leave that 100 pips stop loss in place until the market has moved at least 100 pips in my direction. And then I'll start moving my stop loss with the moving average. So since that hasn't happened yet, there's nothing for me to do. Just leave the market alone, because you can see it's taking my order. I'm in a live trade. It hasn't moved 100 pips in my direction yet. So I'll just leave it alone. Nothing to do. And I'll check again tomorrow morning. So obviously you can see here that the entry price was 1.2114. So 100 pips in my direction will be 1.2014. 1.2014. 1.2014. I just want to see it in the daily time frame. Let's see. So just put there 100 pips. So I can put that there as a marker. So the market, basically what I'm saying is the market breaks that point. It's at the 100 pip mark. So the market goes past that point. It's at that point I'll start moving my stop loss with the moving average. Okay, so that's it for swing trading. Let's go to day trading. Go to the 5-minute time frame. So we can see that the market was initially trending sideways, then it started to trend up, and it's now stopped. It's now trending sideways along R1. So at the moment, you can see let's actually just draw a line there. So you can see where it has gone a high, low, and then since that time it stopped making higher highs and higher lows. Let me make it slightly bigger to mark out my points. So that's the recent low there. So that low is 1.2090 2090. I just want to see it in the 5-minute time frame. It's low. And the highest point is that candlestick there. The high is 2098. 2098 high. Okay, there we are. So the market is currently trending sideways, and we can see that the R1 is easily within the sideways trend. So the market continues to go up. Actually, we can see the market has actually formed the market resistance. Although obviously we can't use that now to trade because we're waiting for the report at 9. Because you can see here the high there is 1.20977, which is 1.2098. That's 2098, and that's 2098. So you can see the market has actually formed a market resistance there, because you can see all these high points are within plus or minus 2 pips from each other. So that's actually a market resistance. That could be a potential point of entry in the market, but we can't use that now because we're waiting for the report at 9 o'clock Rwandan time. So yeah, like I say, if the market goes up, the first point of entry could be the market resistance. The other point of entry is the second resistance, and using the pivot point strategy, we cannot use R2 to trade, so we can't use that to trade. So the only potential buy opportunity is the market resistance. And then from a sell point of view, the market falls. Again, funny enough, the market has also formed the market support, because you can see that low point there is 1.20905. And that there is 1.20906. So that's, again, the market has formed the market support, because the low there is within plus or minus 2 pips from the low at that point. So yeah, interestingly, the market has formed the market resistance and also formed the market support. So if the market falls, you could potentially sell below the market support. But if you miss that, the next point of entry to sell will be below the pivot point. But we'll see what it looks like come 9 o'clock, because by then the market could have broken the resistance and broken the support anyway, but we'll see. So for now, we'll leave it alone and wait to see what the market looks like just before the report at 9 o'clock. Okay, any questions? If you have any questions, you can either send your questions through the chat box, or you can raise your hand and I can unmute you. Any questions, comments, stories? Hello, Elizabeth.
Hello, good morning.
Good morning, how are you?
I'm well, thank you. Once upon a time, I decided to go for the story time.
Once upon a time, okay. Someone was born in a manger.
That's it.
Yeah.
Right, Doc, I've got a question for you. Well,
yeah.
I've got 2 questions for you, actually.
Go ahead.
So the first one is regarding the sideways trend.
Yeah.
You know, you normally say take each day on its merit.
Yes.
So, but I think I noticed once or twice, sometimes you normally pick up sideways trend that trails from a previous day.
Yes.
Why is that? So why I'm asking is, okay, so maybe if yesterday the highest point, it was trading sideways from yesterday,
yes.
you mark your sideways trend, the highest point from yesterday and not from today. Why is that?
Okay, that's a very good question. And the first thing to remember is the market is a continuum. So you can't ignore the previous day. The market is a continuum. It's not, you can't separate the market, so to speak. It's a continuum. So let me actually use just this sideways trend as an example. So for example, if the market does not break this high point or this low point for the next 24 hours, this will still be my sideways trend, even till Friday. So if the market doesn't break this high, are you okay?
Oh no, it's my young trader that's moving.
Okay.
Sorry.
It's all right. It's okay. So basically, if the market does not break this sideways trend, whether if the market stays like this till Friday, this will still be my sideways trend for tomorrow, Thursday, Friday, if it does not break this high or this low. So let's actually go back. Let's go back to yesterday. So let me make it. So if you look at the market here, so this is where it obviously was falling from lower lows, and then it went a bit sideways at that point. Then it started to fall down again. Then at this point, it was trending sideways. So let's just assume we use that as a sideways trend there at that point. So at that point, excuse me, at that point, if the market had stayed, and this was 18th, this was yesterday, okay, this was actually yesterday. So if the market had stayed within these two white lines yesterday up until today, I will still use it as a sideways trend. But obviously it broke it there. So at the time it broke it there, this is no longer useful because it's been broken. And we'll see what the new one is. So now that it's broken, you see what happens. Then again, we had another sideways trend. In fact, this is another reason why I advise people who are new to trading to stick to one market, because you can follow the trend, especially if you're trading on a daily basis, you can follow the trend. So you can see here again, it was going sideways. Then again, it broke it at the top bit there, and then it started to go up. So again, you don't need this sideways trend because it has been broken. And like I said, now that it went up and it stopped going up, then now it's going sideways. So it's a continuum. So like I said, yes, if this market does not break this high and does not break this low today, I will not ignore it tomorrow. It will still be the same. It's because it's the same market. If it's still trending sideways between these two white lines tomorrow, that's what I'll still use tomorrow. I hope that makes sense, Elizabeth.
Yes, thank you. It does. Thank
Pleasure.
you.
So what's the second question? You said there are two questions.
Yeah, the second question is regarding swing trading.
Yeah.
So when you're exiting the market, do you exit based on, okay, we're using the moving average to enter and exit.
Yes.
Sometimes I noticed that I was looking at the I think Euro USD or whatever, going back. Sometimes it does break the moving average, but it's only by the tip of the candlestick, not the whole body. So when you're exiting, do you wait for the body to break it, or is it, I forgot the terminology that we normally use for the edge, like the thin line and the body and all that stuff?
Oh, the wick.
That's it, yes. So if just the wick breaks it, is that your exit point, or do you wait for the whole body to break it before you exit?
That's a very good question, actually. But this now depends. It depends on how pedantic you want to be. But that's a very good question, because it depends on how pedantic you want to be. Let's go back here. So usually, I am not that pedantic. I just move, like I told you. I'll just start moving my stop loss with the moving average, and I don't bother where the candlestick is. I'll just move my stop loss with the moving average. And once the market breaks the moving average, whether it's with the wick or with the body, it will take me out, and I'm fine with that. But yes, in fact, this is the beauty about trading and why I say there's no hard and fast rule. Because some people do exactly what you said. So what some people do is that they wait on a daily basis to see where the candlestick is within the moving average before they move their stop loss. So like you rightly said, let me make it even bigger. So trying to see which one is, okay, let's use this one as a good, that's not a very good example actually. Okay, let's use this one. This is a good one here. So for example, here, you can see, okay, you didn't actually break it here, but you can see with this candlestick, because if you remember the candlestick pattern, when the market is falling, you have this filled candlestick is filled up.
Yes.
So if it's filled up, what it means here is that the market opened at the top here. This is where it opened. It went as high as that point. It went as low as that point, and then it closed at the bottom of this rectangle. Isn't that right?
Yes.
But like you rightly said, but you can see where it closed. It actually closed above the moving average.
Okay.
So in this case, yes, some people will not, they would not have moved their stop loss yet. They would have waited to see this candlestick complete. And because it has moved over, it closed above the moving average, they will still be in the trade. That is the same thing with this one too. So again, this is empty. So that means the market is going up. So that means the market opened at this bottom of the rectangle here, went as low as that point, went as high as that tiny wick there, and closed at the top. So again, with this candlestick, the market still closed above the moving average. So again, they would have still waited there to see that happen. But like I said, I don't do all that. I'm not that pedantic. So for me,
I'm thinking more of the exit in the. So for example, we're using that.
No, that's what I mean. I'm using this as an exit. So if I had bought on this trade, like I told you, I would just move my moving average now with I'll move my stop loss with the moving average without looking at the candlestick. But I'm just emphasizing and agreeing with you that some people, so if they had bought here and they're moving their stop loss with the moving average, they would not automatically move their stop loss with the moving average. They will wait to see how the candlestick ends before they move it. That's what I mean.
Okay, I see.
Yeah, so they wouldn't have exited their live setup. This is a buy trade. They would have bought here. So on this day, they wouldn't have exited. They would have waited. They wouldn't have moved their moving average from the previous day. They wouldn't have moved it. They would have waited to see what this candlestick looks like before they move it. Then same here, they would have waited to see what the candlestick looks like.
Okay, thank you.
So you're right. Some people are that finicky. They will want to see where the market actually closed. If it closed above the moving average, then they will still want to stay in the market. But yes, for someone like me, I would have been taken out here. Once the market just spiked, once it just spiked it here, they'll take me out and I would have been out of the trade. But yeah, some people actually wait and see where the market actually closes. So you're right.
Okay. Thank you.
Pleasure. Any other questions? Well, that's good, Elizabeth. You're a master trader now. You're really looking at the candlestick and all the details, which is very good.
Wishful thinking.
No, but that's good because you see, I like what you did because I think, like I always tell people, that nobody has to trade like me. And I always say, if you speak to 1 million traders, you get 1 million different ways you can trade this market. But the key is knowing what you're doing. So that's why I like your question. I like what you're doing because it just shows that the more knowledge you have about trading, the more you read about trading, the more you practice it, you can begin to slowly come up with different ways you would like to trade based on your own information. Like I always say in trading, so long as you can explain rationally what you're doing, doesn't matter what you're doing. If you can't explain what you're doing, and that's when you're just gambling and just taking pot shots at the market. So for example, just like you rightly said, if you said, look, I did not come out of this trade because the market actually closed above the moving average, that makes sense. Nobody will argue with you because you have a valid reason for doing what you're doing. And that works for swing trading, day trading, any strategy. You can use so many different strategies. But like I said, the bottom line is, so long as you can explain what you're doing and there's a valid logical reason for what you're doing, go ahead. So well done for that.
Thank you.
Pleasure. Any other questions? Let me go back to the 5-minute time frame. Okay, so the market is still, I'm trying to think of what to do come 9 o'clock. I don't like when reports come out, like that report coming out at 9 o'clock, and especially because there's another report coming out at midday. I'm always reluctant to use entry points like the market resistance and market support if the market is too close to it. This is what I'm just considering now and thinking about before 9 o'clock, because usually when the report comes out, the market could just initially do that. You know, there's a bit of volatility for about 5 minutes when the report comes out, when the market is still deciding what it wants to do. So you might find it might just go up, come down, go up, come down within 5 minutes. And this entry point of the market resistance and the market support, you can see is just too close to the market. My worry is that the report comes out, it will just, fall a bit, take your order and go back up, or go up a bit, take your buy order and come back down. So I'm contemplating not using these entry points. If the report, excuse me, if the report at 9 o'clock was the last report of high importance, then I won't be as hesitant as I am now. But because the report at 9 is not the last one, there's another one at 12 noon. That's what's making me hesitant about using this. But the reason why I'm saying all this now is that, come 9 o'clock, you might see I will put a post on the platform that I'm just using the pivot point to sell. And you'll be wondering why didn't Remy use the market support or the market resistance? So that's what I'm trying to explain now, is because these entry points are too close to the market at the moment. And the worry is that the market could just be taken in and out of the trade very quickly. So I'm leaning on just using the pivot point. Obviously, if I don't use the market resistance and the market support, the only potential entry point I will have come 9 o'clock would be to sell below the pivot point, because I can't use R2 to trade. Obviously, if the market breaks the support or the resistance before 9 o'clock, then that would help me with my decision making, because obviously if the market breaks the resistance and support, then I don't need to use it. But if it doesn't, I'm leaning towards not using it anyway and just using the pivot point as an entry point. Now, if we're lucky, which I doubt, but if we're lucky and the market just keeps trending sideways between this market resistance and market support up until 12 noon, time of the last report of high importance, then I'll definitely use it then if it's still available, if it's not been broken by then. Okay, any questions? Any more questions before we go for breakfast? Okay, good. So there are no questions. I wish you all a wonderful breakfast. Enjoy your breakfast. Do keep safe in this COVID times. And we'll catch up on the platform.